G'day there, Investorholics. Thanks for clicking on the video. This is the ETF Spotlight review. Today we'll be looking at A200, which is the BetaShares Australia 200 ETF. Stick around, this is a good one for potentially using as a core part of your balanced portfolio. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's dive on in now. So investment objective is to track the performance of the index that provides exposure to the largest 200 companies listed on the ASX based on their market cap. So A200 provides exposure to the largest 200 companies on the ASX based on their market capitalisation. It can give you a core allocation to Australian equities, so pretty much in one trade you can have it all. Also, I suppose it's a tactical exposure to the Australian share market as well. A low-cost alternative to other active and passive fund managers focused on Australian equities. As I kind of said, pretty much gives you instant diversification, so you own a piece of 200 largest companies in Australia. It's pretty transparent. You can go and have a look on the BetaShares website and look at the holdings, what they own, the amount of, like the number I should say, and all that type of information, what they paid for and blah blah blah, what they're worth. That allows you to calculate the net asset value per unit, and that's always a good thing to know before you buy, because you always, in the ideal world, be paying less than what the actual units are worth. So paying less than the net asset value per unit, that's always the way to go. If you can achieve that, that's always the way to go. So at the close yesterday, we had a net asset value of 91.62, trading just above the net asset value today at $93.33. Market cap of 666 million, I should say, get that right. Very, very cheap. Management cost of 0.07% per annum. Distribution frequency, you'll see dividend quarterly. January, April, July, October. Dividend yield's not too bad, it's around the 4.8% mark. The Australian share market has performed well over the long term, especially when dividends are included, and it should continue to do that over the long term. The main thing that jumps out about this ETF above the other S&P ASX 200 ETF options is that it's a very low annual fee, as I mentioned, 0.07% per annum. This ETF could be appropriate for investors seeking exposure to a diversified portfolio of large ASX companies. I think these ones you're always definitely want to be a long-term holder. So rival exchange traded funds are already cheap, but BetaShares has taken the cost pretty much down, taken it down, charging less than a third the price of the nearest rival today. So IOZ charges 0.09%. You can have a look at IOZ. I'll leave the card up here on the right hand side so you can check out IOZ. As we mentioned, so the ASX 200 tracks the lesser known, may not have actually touched on this actually, so the A200 tracks the lesser known Sole Active Australia 200 index, but pretty much there's only marginal difference between that and the standard index that the other ETFs track anyway, and the performance is pretty much negligible. So yeah, I mean, this little difference in the index constitutes, they all sort of both benchmarks are driven by market cap methodology, so you're going to get pretty well the same outcomes when you're pretty much weighing them and they're all the same weight, so you're going to get the same outcomes. So you're getting pretty much the same exposure to the top 200. I mean, I like this one just because of the fees are lower, and typically over the long run, the lower the fees, the better the performance. So if you're looking at trying to choose between SCW, IOZ, or VAS, I think the fees and the dividend yield is something that probably that you have to juggle and then make your mind up about it as well. But these, I don't think are really anything to trade. They're sort of a buy, hold, and accumulate type of thing as far as I'm concerned. So this one has an inception date of the 7th of May 2018, so it's been running for just over 2 years. Lots of negative numbers there, and best to keep that in mind because there was pretty much a lot of value wiped out off the market on the 23rd of February or the 22nd of February, whatever date it was, with the big COVID-19 crash and all the uncertainty around that. And pretty much all the gains were definitely wiped out by that event that was sitting in this ETF. As you can see, the index is top heavy with the 30% of in the top 5 companies. So CSL, Commonwealth Bank, BHP, Westpac, Woolworths, and a little bit of a National Bank there. And about 45% of the portfolio is mega cap companies, and the remainder are large caps and mid caps, and there's always a little sprinkling of the small cap and micro cap type companies, but predominantly it's all larger companies. So I don't mind this one. So about 80% of the market is either cyclical or sensitive to sensitive, and about the other 20% is defensive. So it's made up the index is made up of a lot of cyclical companies, if I can get my damn tongue around that. And that's just something investors should be aware of. You've got to understand the risk when you get involved in these type of things, but there's always risks involved with everything. But ASX is, A200 is quite diversified, so you should make a good investment in the long run anyway, I think. If you're patient and you actually hold this for over the long term, I don't think you can go wrong with pretty much with any of those the four main ASX 200/300 ETFs that track the market. So A200 will be especially attractive to investors who want a low maintenance, cheap, set and forget portfolio. Current fund levels, those seeking the familiarity of the best known benchmark will find minimal difference in market liquidity. The ETF is an attention grabbing as it's low cost and a great way to gain exposure to Australian equities. So I think, yeah, definitely this one's a good one to look at. As I kind of touched on before, with these, they're all very, very similar. So the way I look at them is, what is the fees I'm being charged and what's the return on them? Because they're all very, very similar products. So they're the top 2 things that I kind of mainly look at. Anyway, hopefully it's been useful and I haven't rambled too much. Yeah, definitely get stuck into it. I think to build your portfolio around one of these ASX 200 or ASX 300 indexes is definitely the way to go. And then sort of bolt on the other bits and pieces, the other bells and whistles that you like. But these are cheap. Over long term, they'll definitely be quite reliable, I think. Anyway, obviously nothing's guaranteed, but I think you've got to be in it to win it and set yourself up and have a go at it. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are, expand your investment horizon, and crack your financial sky. Thanks, guys. See you later.